U.S. national debt has reached a record $37 trillion, according to the latest Treasury Department report that was issued Tuesday.
The Trump administration and Donald Trump's tariff regime is now officially in place. He has been celebrating since late last night. Just before midnight, he posted that billions of dollars, quote, largely from countries that have taken advantage of the United States for many years, will start flowing into the United States. Then, just after midnight, he posted billions of dollars in tariffs are now flowing into the United States of America.
The trade map of North America is collapsing right now, in real time. What Washington thought would be its ultimate show of power has backfired in spectacular fashion. A $37 trillion debt, stubborn inflation, and a reckless 35% tariff war have combined into the perfect storm, turning America's dominance into its downfall. And in the chaos, Canada has moved with precision. Instead of breaking under pressure, Ottawa is seizing the crown Washington thought it would never lose. Ports are humming, railways are redirecting global cargo, and Mexico has joined Canada in building a shield that cuts right through U.S. leverage. This isn't just a trade dispute, it's a regional rewiring. The U.S. once controlled the flow of goods across the continent. Now, its own policies are writing it out of the script. Like and subscribe, and keep watching, because what comes next will shock you. The storm began with one decision. On August 1st, the United States imposed sweeping 35% tariffs on Canadian goods and dozens of other imports outside the USMCA zone. Washington framed it as a crackdown on fentanyl smuggling, on unfair trade, on Canada's defiance over foreign policy. The message was clear: bow to U.S. pressure or pay the price. But the reality was far different. America was already buckling under the weight of a $37 trillion national debt. Inflation wasn't just lingering, it was embedded in daily life. Groceries cost more each month, gas prices lurched upward, and credit card balances soared. Into that fragile environment, the White House injected a tariff bomb that instantly made everything more expensive. Consumers felt it first. A truckload of Canadian aluminum meant for Detroit's auto plants suddenly cost thousands more. Wheat from the Canadian prairies, once a staple for U.S. food processors, jumped in price overnight. At Walmart, Target, and Costco, the increase showed up within weeks, price tags climbing on canned goods, construction materials, even energy-efficient appliances. Households already squeezed by mortgage payments and credit card debt now faced a new reality. The tariff was an invisible tax, draining wallets without a vote in Congress. It wasn't just the rich paying more, it was the middle-class family in Ohio, the farmer in Iowa, the small business owner in Michigan. The pressure didn't stop at the checkout counter. Businesses across the Midwest slowed orders. Auto plants in Illinois and Michigan cut back shifts. Construction projects stalled as aluminum, steel, and timber costs spiked. Retailers quietly scaled back holiday orders, bracing for a consumer slowdown. America's own labor market began to wobble. For months, job growth had been steady, if modest. But by fall, hiring freezes spread. Temporary workers were the first to go. Then came layoffs. What was supposed to be Washington's hammer against Canada became a boomerang hitting American workers. And Canada? Ottawa didn't blink. Under Prime Minister Mark Carney, Canada refused to bow. Instead, it doubled down on a strategy years in the making: trade diversification. For decades, Canada relied heavily on its southern neighbor, with nearly 80% of exports flowing into the United States. But Carney's government saw an opening. If the U.S. wanted to shut doors, Canada would open others. Billions had already been invested in modernizing ports in Vancouver, Halifax, and Prince Rupert. Now those upgrades became lifelines. Container ships once routed through Los Angeles and Seattle began docking in British Columbia, bypassing U.S. choke points entirely. New rail links carried Asian goods eastward across Canada, feeding supply chains in Europe through Atlantic ports. And the numbers told the story. Canada's export share to the U.S. slipped, from 78% down to 74%, and then to 70%. Analysts projected it could fall to 68% within a year. What once seemed unthinkable, Canada loosening its dependence on the U.S., was happening in plain sight. Washington's gamble had backfired spectacularly. Instead of forcing Canada into submission, it accelerated Ottawa's breakaway. But that wasn't the only shock. Mexico entered the picture. For years, Mexico's manufacturing might have been tied tightly to the U.S., especially in the auto sector. But under the shadow of Washington's tariff chaos, Mexico saw the same writing on the wall as Canada. Dependence was vulnerability. So the two neighbors began to stitch together an alliance. At the heart of it was energy and logistics. Canada's vast crude oil reserves supplied over half of U.S. imports. Mexico controlled key manufacturing corridors. Together, they envisioned something bigger, a North American trade shield that didn't depend on Washington's approval. And they had the firepower to back it up. Canada's Maple 8 pension funds, managing over $2 trillion, poured capital into rail expansions, port facilities, and energy infrastructure. In Mexico, billions flowed into new logistics hubs, storage depots, and energy transition projects. The result? A new continental network, Canada and Mexico, side by side, insulating themselves from U.S. volatility. The White House didn't anticipate this level of defiance. Policy advisors assumed Canada would grumble but comply. They assumed Mexico, too dependent on U.S. trade, would stay quiet. Instead, both countries turned inward, strengthened ties, and built escape hatches from America's leverage. Meanwhile, U.S. consumers kept paying. The inflationary effect of tariffs was undeniable. The Federal Reserve faced an impossible choice: raise interest rates higher, risking a recession, or sit still and let prices run hotter. Either way, households were caught in the crossfire, and investors began to notice. Global capital that once treated the U.S. as the default safe haven started eyeing Canada differently. Pension funds, sovereign wealth funds, and multinational corporations began shifting pieces of their supply chains north. Vancouver's port expansion turned into a magnet for Pacific trade. Toronto financial markets attracted foreign listings. Alberta, long dependent on U.S. energy buyers, began signing export contracts with Asian refiners. The psychological shift was just as damaging as the economic one. For decades, Washington's neighbors were seen as junior partners. Now, in the wake of the tariff war, the balance was changing. Canada and Mexico were no longer just suppliers. They were becoming trade powers in their own right. And it wasn't only government policy driving this shift. U.S. corporations themselves began hedging bets. Facing higher costs and endless uncertainty, companies quietly explored moving parts of their operations to Canada. Manufacturing clusters formed around Ontario and Quebec. Logistics firms shifted cargo routing to Halifax instead of New Jersey. Even tech firms eyed Canada's stable market and immigration-friendly policies as an alternative to Washington gridlock. What started as a tariff fight was morphing into something much larger, a reordering of North American commerce. But this was just the beginning. Because while Canada was diversifying trade and Mexico was reinforcing supply chains, another silent weapon was looming in the background: energy. The one card Washington thought it could always play. For decades, U.S. leaders assumed North America's oil and gas flows worked in their favor. But the reality in 2025 was brutally different. America was the dependent one. Over half of U.S. crude imports came from a single source: Canada. Pipelines stretching from Alberta's oil sands to refineries in the Midwest and Gulf kept America's economy running. Without that flow, gasoline prices would skyrocket within weeks. It was Canada's silent weapon, and Ottawa knew it. Carney never threatened to cut supply outright. He didn't need to. Just the possibility was enough. Each time Washington turned up the pressure, energy markets jittered. Traders factored in the risk, pushing oil prices higher. Consumers at U.S. gas stations felt the hit almost instantly. The very dependency that Washington thought gave it leverage had flipped into Canada's hand. Meanwhile, Canada was no longer just an energy exporter, it was an energy strategist. Billions were redirected into LNG terminals on both coasts, positioning Canada to supply Europe and Asia directly. Ottawa's message to the world was clear. Canada wasn't just America's supplier, it was a global energy player. This shift hit Washington hard, because even as America tried to flex with tariffs, its own refiners, airlines, and transport sectors quietly begged for stability. Behind closed doors, CEOs warned, if Canadian crude faltered, the U.S. economy would buckle. And so, Washington's threat posture collapsed under the weight of its own dependence. But energy was only part of the story. Corporate geography was shifting at lightning speed. U.S. firms, desperate to escape the tariff trap, began relocating supply chains northward. Auto manufacturers eyed Ontario's stable policy environment and cheaper access to European markets through Canadian ports. Logistics firms rerouted cargo through Halifax and Montreal, avoiding congested and tariff-burdened U.S. hubs. Even agriculture firms began processing in Canada before re-exporting to Asia. The logic was simple. Canada was becoming the safer bet. And it wasn't just multinationals. Medium-sized U.S. companies, the backbone of the Midwest economy, began exploring Canadian subsidiaries as a way to bypass tariffs. Suddenly, Ottawa was fielding calls not from lobbyists pleading for relief, but from U.S. business leaders asking how to move north. The result? American workers left behind, watching their own companies invest across the border. Job losses rippled through Ohio, Michigan, and Illinois, while new opportunities sprouted in Ontario and Quebec. Washington's tariff war had effectively subsidized Canada's economic boom. Investors called it the Great Realignment. Wall Street analysts spoke openly about a once unthinkable trend: Canada emerging as the new commercial hub of North America. Numbers confirmed it. Canadian exports to Asia hit record highs. Port traffic in Vancouver surged 27% year-over-year. Halifax and Montreal saw double-digit growth. Meanwhile, U.S. ports from Long Beach to New Jersey reported sharp declines, as shipping companies avoided tariff uncertainty. And then came the kicker. Trade diversification wasn't just regional, it was global. For the first time, Canada's trade profile looked less like a satellite of the U.S. and more like an independent global hub. European partners signed long-term deals for Canadian grain and energy. Asian investors poured capital into Canadian tech and infrastructure. Even Latin American countries began routing through Canadian logistics corridors tied to Mexico. The U.S. watched, unable to reverse the tide. The export share numbers told the whole story. Canada's reliance on the U.S. market had dropped from 78% to 68%. In under 2 years, Ottawa had shifted 10 full percentage points away from its southern neighbor, a historic move that fundamentally rewired the trade map. For Washington, this was a nightmare. Because the more Canada diversified, the less effective U.S. tariffs became. Each percentage point lost meant diminished leverage, reduced influence, and greater vulnerability. America wasn't just losing trade flows, it was losing control. And while politicians in Washington bickered, Canada and Mexico were busy cementing their alliance. The Maple 8 funds fueled rail expansion from Vancouver through to Mexico's Pacific ports. Energy corridors linked Canadian oil with Mexican refineries. A continental grid was forming, one that bypassed the United States altogether. The symbolism was devastating. For decades, America had been the indispensable middleman of North American commerce. Now it was being cut out of its own neighborhood. By late 2025, the U.S. economy looked like it was being squeezed from both ends. On one side, tariffs had turned into an inflationary tax that punished households. On the other, Canada and Mexico were offering foreign investors a more stable and predictable environment. The squeeze was relentless, and Washington had no easy escape. The irony was staggering. America, once the architect of North American trade, had rewritten the rules against itself. Its 35% tariffs, meant to punish, had become the very tool that accelerated its decline. And yet, the White House refused to back down. The administration framed the crisis as short-term pain for long-term gain. But the pain wasn't short-term, and the gain never arrived. Factories closed. Consumers buckled. Canada expanded. It was a shift no one in Washington wanted to admit. The United States was losing its trade crown. The final question was no longer whether Canada could survive without the U.S. The question was whether the U.S. could survive without Canada. Because if Canada kept building its alliances, if Mexico kept reinforcing its logistics, and if U.S. firms kept moving north, then the balance of power in North America wasn't just shifting. It was being permanently rewritten. North America's trade order has been rewritten, and the U.S. didn't see it coming. A $37 trillion debt, a reckless tariff war, and a collapsing grip on regional commerce have left Washington weaker than at any point in modern history. Canada and Mexico are no longer junior partners. They're building an alternative system, and the numbers prove it. So the question now isn't whether Canada can stand without the U.S. The question is whether America can adapt or be left behind. If the US fails to confront reality, the balance of power won't just tilt, it will lock into place. And once locked, there's no going back. If you found this breakdown valuable, hit the like button, subscribe, and turn on notifications. Because the next chapter in this story is coming fast, and you won't want to miss it.